Check, check. All right, looks like we're good to go. Good morning, everyone. Good to be with you. Today is Tuesday, February 16th. Good to be with you for this live intraday strategy webinar. Eileen, Mario, Farouk, Graham, Hussein, John, great to see you in the room. Kay, always a pleasure. So let's jump right into this session. It's going to be a shortened holiday week, obviously. We do have full participation returning today to markets. Very interesting price action. We're tracking some of the dollar crosses. If you're on the swing side of things, we're holding a long Aussie dollar on that side as well. Stop on that one is still 69.66. And last night we covered in the intraday charts, we went over the Kiwi, the dollar Swiss, the Euro Aussie. We touched on Aussie, Aussie Key, and Sterling Aus. So the Aussie crosses are in focus. Do keep in mind this week, heading into, I believe it's Wednesday, we do get the release of the Aussie employment data. We're expecting that to be sort of the biggest market mover this week, at least for the Aussie. As far as today's concerned, you do have some Fed members on tap for speeches. No major any key data really of note heading into the U.S. session. We just got Empire Manufacturing coming in slightly weaker than expected. You're seeing the dollar trading off today against its major counterparts here. Relative performance looks mixed on the session. You got the yen with an advance of 0.73%, Aussie up 0.22, CAD even up 0.15. Biggest loser on this session, and the trade that we highlighted yesterday, again, remains the Kiwi dollar down almost 1% so far to start off the day. Hey, Mike, great to see you in the room. Says, good morning, I'm on time today. Great to have you here on time, my man. All right, so as always, guys, feel free anytime throughout the course of the webinar, if you have any questions, trade setups you want to specifically cover, or anything with regards to strategy, please feel free to throw it on the message board. Okay, so relative performance, like I said, is rather mixed on this session so far. We're going to keep coming back to this, guys, and I want to try to sort of highlight this a little bit more often throughout the course of the week. So this is the relative implied interest rates, excuse me, from the Fed and what the market's pricing in. I've showed you this a couple of times last week, but I just want to continue to emphasize how much market expectations are pushing back further interest rate hikes from the Fed. If you take a quick look at this, we are currently at 0.5 rather percent on the interest rates. Markets are expecting us to stay at 0.25% pretty much at least into third quarter, where you start to see a little bit more of a percentage higher for a move to 50 basis points. But the point being, if we just look and track the most latest month, you can see that market expectations for higher rates from the Fed have continued to get kicked out. Okay, some of that bid that we saw for the dollar early in the year on expectations that the Fed's going to hike 4 times this year, really starting to evaporate really quick. Now, this can change, and this does change on a daily basis, so we'll keep coming back to this week. I just want to let you know, again, we've dropped to the lowest levels, or rather for the 0.5%, lowest levels that we've seen in a while, okay, meaning interest rates are expected to hold at 0.25 to 0.5 here, pretty much heading into third quarter. With that in mind, Mark, great to see you in the room, sir. Let's jump in right to the charts. Part of the major headlines that you heard in overnight trade is that you did hear Saudi oil minister says that they're agreeing to freeze oil production. We haven't gotten many details on that. You've seen a little, let's don't want to say a little, but a decent rebound, at least near term, in oil prices. Here's what it looked like last night. We've given up most of those advances, but look where we capped out. And I tweeted this chart last night because I thought this was going to be a big level at 31.44, and in fact caught the high almost to the pip. This is a basic 618 retracement of the decline off of that January high. More importantly, basic trendline support, now resistance, and the current median line of the operative formation off the high from September and October. So your key region of resistance, we saw a tag of it today. Again, this is still going to remain the main threshold to suggest that you're going to see a little bit more of a recovery here in gold. Near-term resistance 31.45. Key support at this point, we're going to look for the low day close, and that's at 27.24. So some things to note here before we jump into the crosses. Just want to look at crude. You know, change in behavior could be underway here. We did note that you're seeing some strong divergence into those lows, price action making a lower low, the oscillator making a higher low, bullish divergence. Also the fact that that former resistance trigger, a 3-point resistance trigger, broke and offered support on both of those divergent levels. So certainly suggests that near term you want to be mindful. Specifically, a break above 31.44 would suggest that you have a little bit more of a key reversal, at least near term, in place for crude. That remains to be seen. But the key levels are pretty clean. All right. Now for the dollar CAD, it looks very interesting on this prospect. I didn't cover that yesterday because I don't really like the near-term price action from a scalping standpoint, but we'll definitely take a look at that later on this session. Mike wants to look at euro dollar if you get a chance. Absolutely. Let me jot that down. US dollar and dollar CAD. Okay. All right. So let's jump through the setups from last night real quick, and then we'll jump into some of your questions and some of the exogenous markets. So again, just taking a quick look at the dollar index, the pivot here at the 38 retracement off the low from May, 12,059, offered some nice resistance before that Friday rally popped back above. The major key invalidation level for the short side still remains up here. So as long as you stay below 12,123, you guys remember that 123 level was something we talked about last year. For the last couple of months of last year, still a major key pivot in price, but now the median line here coincides right on that level. So you got the April high day close. There was a lot there at that 123. The 2016 open comes in just higher, 12,131. And you got that 100-day right there at 12,115. Long story short, this is the bearish invalidation level. So even if the market does rally into this region, we'd still be looking for possible short triggers on the dollar index. So now that we have kind of a base picture of what the dollar looks like, as far as support, that remains the break below 200-day moving average. You're still looking for that run, 11,970. We just missed that here on that turn last week, but that's still the support of focus, let's say, if we make it back below that 1249 level. So looking into last night's updates from the intraday charts, first things first, Kiwi dollar. We were following this pretty aggressively last week. Here's what the daily chart looks like. Here's what the daily chart looked like last night. Remember, our bearish invalidation remains 65.55, 65.59. We did see a slight run towards that, but we didn't get quite up there, excuse me, before turning over. So we're looking to maintain that short bias sub 65.59. We need a break sub 65.48 to really give us the validation of a broader turn here in the Kiwi dollar. Here's what Kiwi looks like at this point. I'm sorry, I was saying 65.59, guys. 67.59, 67.55, this region. So this was still the bearish invalidation level. Here's the weekly opening range. We came right into this resistance at 67.77. You had the 200-day moving average up there. You had the upper median line parallel up there. And we were looking for short triggers. You didn't really get quite a very clear short trigger on this, except for the rejection at 60. But there's a break below the open. Key support that we need to validate a more prominent or a more key reversal would be a break below 65.50, 65.48. Okay, and that's the downside target on this move here. So Kiwi, on the broader scope of things, here's what it looked like on the scalp yesterday. We came right into this level. Again, momentum held at 60. On a near-term chart, if you brought this into a 5, guys, there was a pretty decent trigger. It happened pretty quick, though. So I don't blame you if you missed it. Long story short, we're just coming to the full week, full circulation around the globe here with market participation coming back into the markets after yesterday's holiday here in the United States. And I think we'll get a lot more play on these dollar crosses. But long story short, looking for short triggers, looking for a move back towards 65.50, 65.48. And again, this is going to be the real key support that we need to clear near term. Eileen says, yeah, I missed that Kiwi last night. I don't blame you. I missed it too. I wasn't really too keen on getting involved in too much, Eileen, in these shortened holiday weeks. I like to find, go around the globe once at least for the week to see what markets are doing. That being said, on the 5-minute, well, this is the 1-minute, but I do want to show you on the 5-minute, on that break, here's what it looked like. So you actually had a really decent trigger right there on the 5-minute heading into that high. And more importantly, why it was important is because it was the weekly opening range high. So if you open the week, we came right into that region of resistance, okay? You got that trigger right as price was testing the opening range high. That's going to be your ideal type of scalps, guys, because you're trading against the weekly high, you have a near-term triggered momentum, and you have a well-defined at least range that you're trading on the extremes. So those trades are always going to be your most beneficial. Keep in mind, a quarter of the daily ATR is still offering only about 27 pips per scalp. So every 27 pips, we want to be taking some off the table. At this point, again, look for that move back towards that key support there at 65.48, 65.50. Hey, Minho, great to see you in the room, man. So Kiwi still in our focus. You know, the long side last week, we were looking for the trade. If you guys remember Kiwi dollar, and I did link the previous report here, here's what it looked like back on the 11th of last week. And we were looking for this region, which was giving us some divergence to sort of teeter out the highs here for Kiwi dollar. Well, those two spikes actually ended up being the high. And if you guys remember the short that we took the previous day on Thursday, on Friday, you got the same exact play back again. Okay, so we finally made it down below that upper or rising median line formation, downside break, even the sliding parallel gave at this point. Looking to play the downside here in Kiwi. Was watching for divergence on Kiwi 2, but didn't catch that extreme. Yeah, it happened pretty quick. And again, it happened right a couple hours into Asia trade. There was one other thing I wanted to look at that happened yesterday. Oh, here it is. The Kiwi did release yesterday some data, and here's what it looked like. It might have sort of contributed to the decline that you're looking at here. 2-year inflation expectations, you saw that drop from 1.85% to 1.63%. You're seeing that's not a very high relative importance item, but even the retail sales stripping out inflation for the fourth quarter, you saw that come in way below expectations at 1.2%. And not only that, a downgrade to the previous month from the previous quarter, from 1.6 to 1.5. So again, these continued deflationary concerns around the market, guys, around the globe, is the main focus for all of these central banks. And every time you see inflation numbers miss expectations or inflation expectations miss the mark, you're going to see downside pressure on the respective currency. Why? Because the easiest and most direct thing central banks will do is try to, again, devalue the currency, keep the interest rates low to spur that inflation. So again, some weaker numbers here yesterday in Kiwi may have contributed to this decline here. Long story short, the technical structure was still having us looking lower. So either way, the market always provides more. She likes that, Eileen. Mark says Kiwi dollar right at daily trend line right now. Just took a long at 65.77 with a stop loss right under 65.47. Right at that daily trend line. Let me see what you're talking about here, Mark. I think you're just looking at a basic trend line off the low here. I see what you're looking at. Yeah, it might be worth a bounce, but just keep in mind one thing. On the real near-term chart, momentum still hasn't turned per se. Now, one thing that you have going for you is that you're getting some ongoing divergence here, Mark. But this hold at 60, breaks up 40. Just be a little bit more cautious on this one. I think if you get that pop above the London opening range, you get a little bit more of a reversal. But remember, either way, on a trade like this, for those of us who are scalping this on the trend, we're looking to sell rallies. A recovery here might be underway. You're looking for 27 pips. You could get it, but I'd still be looking rather, Mark, for me, on a rally to get back on the short side, to be honest with you. One other thing I just wanted to pop on here real quick. I think I have it on here on the scalp chart. Yeah, is the extension off the high. So a quick basic extension off the high, 2 equal legs down, again takes you into that key support we just noted, which would validate a broader turn. And a break below that, the next extension of that same move takes you all the way down 64.35. Now this helps our case for Aussie Kiwi. If you looked at last night's swing report, Jamie's looking for an Aussie Kiwi long position. Didn't get the pullback. I saw it last night right on that Kiwi sell-off. Aussie Ki ripped right through the highs. Mark, you're more than welcome, sir. Appreciate that. Looking at Aussie Ki, just a quick segue here. It would have been a great trade. I mean, Jamie was right on. We were looking for entry at 106.60. We didn't get the move lower to open up the week. That Kiwi drop off yesterday really launching this pair right into resistance. So I'm just looking at this real crude median line, very loose off the lows here from January. And you're seeing a 764 retracement of the entire decline sort of confluence there, which is what we highlighted last week. We're just below that region now. Again, something that, Mark, you'll want to look at. I wouldn't be surprised to see a little bit of recovery here. Move down Aussie Kiwi, some Kiwi recovery, move up, but we'd look to reassert that same directional trend. All right, so wouldn't be too surprised to see that Kiwi near-term mark move a little bit higher on a pullback here. But the puzzle piece is sort of fixed here for a little bit of concerted move higher in Aussie Key. For Aussie Key, I do want to just highlight the major critical resistance is still into 109, 109.10. Big region. If you guys remember, we called this the slope of influence for Aussie Kiwi for months. That operative slope from the 2014 January low has continued to define all the major turns for the last couple of years. And you saw that we turned even this last turn last week right off that same slope. Okay, we just broke through that slope again. And while there's no slope up here, this 109.10, 109.35 region has defined so many pivots in price last year that it's going to remain a major critical region, and is also has the high day close for the year so far. 200-day moving average slides in there as well, right around 109.16. And this is going to be the major key resistance level for Aussie Key. So for anyone who's playing the long side of that scalp, just be mindful of that 109.20, 109.10 region. Craig, welcome aboard. Says, sorry I'm late. Mike, did you already cover? No, we haven't covered CAD or oil. We'll definitely jump into both of those. Craig, we just spoke briefly of oil, but we'll jump again into that. No worries. Any questions on Aussie Key or Kiwi dollar from last night? So the biases remain the same. No change on those. Bearish and validation level remains up here. Reversal confirmation, a break below 65.50. All right, next up on tap last night was dollar Swiss, another trade that we've been following very closely since last week. You guys know I'm not really a big fan of trading the dollar Swiss, but when the setup is there, the setup is there. So we were talking last week about this major key support that we came into, basically the 97 handle, let's call it. You had 100 off the high right there. You had a 50% off the low right there. You had the 200-day moving average in there and median line right off the highs from November, all on that region. You saw a pop off that last week. We're looking for that top side to teeter out. And while the immediate top side bias is in play, inevitably, we'd be looking to sell that rally. It's important to keep in prospect where we are in trend. So here's what dollar Swiss looks like on the daily now. Okay, not much change really. It's held a pretty tight range. The bearish invalidation level, i.e. key resistance, the only thing that would shift our bias to the long side is right up here. 618 retracement, the upper median line parallel, and if I'm not mistaken, the 2016 open. Okay, major key support, that 97 barrier. Here's what the intraday chart looks like. Here's what the scalp looked like last night. Here's what we look like right now. Okay, so a really tight range, no play on this yet. It does have a decent 26 pip ATR, so I think we will get some decent plays. The premise is this near term, and what I was thinking of heading into the US trade session today, I was actually looking, and this is where it's important to kind of keep in mind where we are. Our bias that we noted last night is looking for longs, right? But if we continue to break, or if we continue to hold this resistance and break below the median line, you might have a decent play back towards 98.30, back towards this region, where I think, again, we would start to look to assert the long side. Long story short, inevitably, we'd be looking to sell this rally, but near term, I do think the dollar has a little bit more possibly to give back before it turns over. So if you see a break below the median line here, I'll be looking to sell rallies. More importantly, if I miss any of that, I'll be looking for a pullback to offer some nice long exposure down to that 97.37 level. With such a strong move up in Swiss, why the long trend down and looking to sell. Seems to be looking for longs on dollar Swiss. So Eileen, keeping things in perspective, right? The immediate focus is still higher. Remember last week, guys, on dollar Swiss from the 11th. If you remember this, we were looking for this downside channel to break for the entire week. We highlighted it on the 10th. Again, it's the end of the week. We're saying, let's wait for this. You know, we're waiting for a topside break. We were at key support. We're looking for a topside break to play the recovery. Well, we got that topside break late last week. So the focus is still for the recovery. But Eileen, on the broader chart, right, still got a little bit more to go to the downside. And we're talking about the dollar having made a pretty major, I don't want to say key reversal yet, but the dollar index pretty important near-term high. And if the dollar is looking to play lower, the recovery near term might give us dollar Swiss higher in the near term, but broadly I'd be looking to sell that again. Does that make sense? Eileen says, I see, but the long-term seems to be stronger trend. So it depends what we're looking to do on this. Eileen, on face value, I would say that this is still a range. Here's your pre-SNB peg cut, and we just tested that twice and failed. So I would say this thing is still broadly in a range, and that still puts us at this point still closer to the upper bound of that range than the lower bound of that range. I know what you're talking about. Absolutely, yeah, we are still in this sort of upward slope, but the highs that we made, the first deep break below 40 here in momentum, I still think that you'd look for a rally here to get back on the short side for dollar Swiss. Oh, I see now. 2 with the highs holding. You see that? And again, this is the pre-peg high. So obviously that was a whole fiasco. Markets have sort of, the hangover effect of that move I think has sort of played out. We're trying to press those pre-peg highs or post the pull of the peg, and the market failed on both attempts. On its face value, to be quite frank with you guys, we're playing ping pong right now between the 100-day moving average, which has offered key support and nice pivot in price, and the 200, which has been doing the same exact thing. So this is your major range of focus, at least to start this week. Ideally, you get to move back towards parity there to get back on the short side. Questions on dollar Swiss? Immediate focus, still trying to see if we can get a little bit more of a higher recovery here after that downside break. All right, moving right along, Euro Oz was last up from last night as well. Sorry about that, that's not the right one. Euro Oz. So a nice wide range ATR. I love trading Euro Oz lately. Has been really nice as far as the range has been giving us. An overnight trade, can't say that it was too impressive when I got in this morning. Here's what Euro Oz looks like on the daily. You're seeing a little bit of a reaction here to that median line off the low. Euro Oz, the focus is higher from here. Again, inevitably would be looking to sell, as we noted yesterday in the piece. Here's what the intraday chart looks like from last night, and here's what we were looking at last night. So 55.23 is a basic 38.2. You saw the convergence of that later in the week. We're basically looking for a near-term rebound off of that median line. Inevitably, like I said, we would be looking to sell, but the focus is on that near-term recovery. Here it is. Again, we were noting yesterday the divergence. It finally gave a crack here to the upside. You're not seeing much follow through. I do think that you see a move higher here in US trade today. Again, we'll be looking for an area to get short. This is another one of those trades that we were following last week with a bearish invalidation level of 60.95. You saw that we probed that twice and failed. 60.95 is the high day close, if I'm not mistaken, for September. A fail of that, break of the median line. This now is tempting a break of the rising median line off of the high, off of the low rather. So again, break of support, possibly check his resistance to move lower. Broader bearish invalidation level is still going to be up at 60.95. So looking for a rally here to sell in Euro Aus. And again, with the Aussie long position that we're looking at on the swing side of trades, that gives us further conviction for strength in the Aussie, Euro Aussie lower. Someone asking, can you drill with Euro Aus for the sell point possibility on the 5-day chart, or the 5-minute chart rather? Let's see what it's looking like. Sterling Aus, by the way, is also a very interesting thing I highlighted on the radar chart. I think we'll look at that in a moment. But what are you looking for? Euro Aus. So here's a near-term scalp possibility right here. Okay. Very interesting. So divergence, divergence, divergence. It's only a 1-minute chart, so you got to take it in stride. Higher high, higher high, lower high, lower high. This trigger break didn't give you much of anything on the way down, but the reversal or the attempt higher, now finding resistance at former support. Okay, so again, risk here near term, the immediate risk heading to US sessions for a pull lower back towards that 56 handle. I would personally like to see a little bit more recovery off that median line to try to press a little bit more of a more conviction short, Eileen. But if that downside breaks, yeah, sure, that could be a decent scalp for sure. Remember, on this trade, you're looking for 65 pips. It's a big range. Okay, so heading to the US session, if that trigger does give out and you continue to see that downside move, you look for about 60 pips on the downside here to wrap it up. I don't, or just as a word of caution, for me personally, I really wouldn't be looking to take anything past that 55.25 level unless that gives out. So if you have any shorts on play into this move, I'd start to clean it up as we get into that region. Again, wouldn't put it past this thing to tag that 55.23 before giving us at least a near-term recovery. But I think the levels are pretty clean here on Euro Aus. So sort of the near-term formation that we're in, and sort of the broader term formation is there. Mark says, buy everything Euro, LOL. So we can take a look at Euro dollar actually in a moment. Any questions on Euro Aus before we move off? Okay, so the radar charts looked really good on a couple different things I'll be tracking this week. Aussie dollar, I just wanted to highlight what the near-term chart was looking like. We were just wanted to look at that 71.70, 71.77 region of resistance last night. On Aussie dollar, you saw that held as resistance near term. That's a longer-term 618 retracement key. You saw that tag here today. Here's what the near-term chart looked like from last night's scalp. So ideally, again, for the Aussie, might get a decent pullback off this region. I would be looking to get back on the long side. Bullish invalidation level is 70.37, 70.34, this region here. Nice confluence of the 50% retracement of the advance. A longer dated 100% extension of the advance as well. And that lower median line parallel all coincide right there at 70.37. Okay. The swing trade is long with a stop at 69.66, so it would require necessitate a break below our invalidation level there. But looking pretty good, I think, for the Aussie. If you're not in that, I think you get a decent pullback here to get opportunity to get back in it. But broadly looking for a rally here in Aus. And again, here's what the daily looks like. Questions on Aussie dollar? And like I said, that Aussie employment data does come out tomorrow. Employment data, you're looking for a print of 13,000. Widely expect to see the unemployment rate hold at 5.8% in Australia tomorrow. More so than the actual print number, there's been a lot of emphasis on whether the gains are mostly in full-time or part-time work. Last time around, we saw a really big, strong build at 17,000 for the full-time. So we'll look to see if we can continue to see strength in the participation rate as well. Eileen says, where are the Aussie dollar targets? So on a topside break, Eileen, you're looking for 72.37 and 72.77. This is the extension off the low there. Near-term support and the open for the month, or the open for the week, excuse me, comes in at 70.97. Bullish invalidations here. The gap is a little bit larger, I'm well aware, than the 30 pip or 26 pip ATR that you're looking at. But we don't want to just start throwing levels for the heck of it. If there's nothing in between, then we got to look at that next key level. Minho saying a break of the higher high, a higher low in the 30-minute chart, bullish momentum fading. Right, so you're looking at this, right? Exactly. This is why we were saying you could get a decent pullback to get back on the long here. So you're absolutely right. Price action, higher high, higher high, higher high, right? And especially when you're looking at that, guys, always remember we're only looking at the close. So still higher high, higher high, higher high. You're absolutely right. Lower high, trigger break. So yeah, you could get a decent pullback from here. Absolutely. You'd be looking for that pullback to offer a decent long trigger on the way down with, again, our bullish invalidation level near term still right here at 70.35. Does that make sense, Minho? Still looking for long triggers. If you want to try to attack the short side of the trade for a scalp, you could definitely get it. I would just be really cautious, and I want to keep it pretty nimble. See what the near-term chart looks like for Aussie. Yeah, so you're getting some of that divergence here. Price action, higher high, higher high, higher high, series of lower highs. But you're not getting much of a conviction shift turn yet. So I wouldn't necessarily jump into a short from here, Minho. I would, again, that ship has sort of sailed, I think. You would have wanted to take a little bit more of a trade against the high for the session. I'd rather be looking for a pullback to get back on the long side, to be honest. So we'll see if we can't get a play on that here today in US trade. Minho says, yeah, thanks. You're more than welcome, sir. All right, so that is the Aussie dollar. Next up from last night's radar chart was the Aussie key. And here's another one that, again, like I said, the swing trades you're trying to get into yesterday. I loved the trade. I thought it was going to be a great idea. Obviously, you got that break in the Kiwi, which really gave lift to the Aussie key. And again, just touch base on this chart one more time on the daily chart. The major region of resistance still that 109 region to 109.35. If we're going to attack that slope again from the underbelly, you could see this thing as high as 110 again. But the immediate major key resistance is still this region right here. 30-minute looks like this. So still kind of sitting there dilly-dallying around that median line. Do keep in mind, guys, just for the record, Aussie key is notorious. There's a lot of back and forth price action. So for near-term traders, you kind of want to take a little bit more of a static approach. You don't want to look too deep into price action because it does tend to give you a lot of this chop. And we haven't really put any positions on this one for the last couple of weeks. I'll see if I can get another pullback here to get back on the long side. But near term, you're right at that, just shy of that major key resistance into the 109 level. A decent trade on this, actually, guys. And just looking at it right now, heading into later into the week, if we get a run into this region, a short off of this for a move back, and then another buy entry to get back through is sort of my ideal. If things were in an ideal scenario, how would I look to play this? But right now, you're still looking for that move into 109. Last but not least, that Sterling Aussie position, or that Sterling Aussie daily chart. I just wanted to highlight this major key range. I do think you look for the break and the resolution of this consolidation here this week. You're looking for either a break sub 109 I'm sorry, 190, basically 199 down here, or breach above 206.50. Very wide range ATR, gets you 260 pips on a daily basis. So once we finally get this consolidation break and clear out, I think we get a decent directional play. Ideally, you'd see a downside break here below 198.60 or 198.90, excuse me, for a drop towards that 192 hit level. Big range. That's sort of my ideal scenario. But long story short, we'll be looking for a resolution of this consolidation that we're in this week. Okay, with a downside break definitely favored here in sterling Oz. Any questions on this pair? Again, the near-term chart, it's kind of a little messy here. I'll show it to you real quick. I was just peeking at this yesterday. Any minute now. Okay. Okay, so here's what it looks like. Okay, and within the confines of that consolidation, there is this median line that we've been following, just a basic median mirroring that resistance that we're seeing along the highs. 99.95, again, the low that we made, that's the exact sort of consolidation region that we're looking to clear. Downside break favored, look for a break sub 98.99. And same thing in momentum. Same consolidation in price is in momentum, so it gives us further conviction when we finally clear this consolidation, heading pretty close to the apex here. I think we'll get a directional break to the downside. Any questions on sterling Oz? On those wider range ATR guys, by the way, I don't really like to get involved too much with the scalp until there's a clear definitive bias, because again, the implication is a very wrong trade or a 66 pip loss. So just to let you put it out there, I haven't touched this yet. I am still favoring a move either back towards the upper median line parallel here to try to take a stop against last week's high, or if we break to the downside for the final move and break this consolidation, I think you'll get plenty of opportunities on a rebound to get back on the short towards 192.23. And that is sterling Oz. All right, so let's jump into some of your questions, guys. I know you guys want to look at the dollar CAD, the euro dollar, dollar yen. I just want to put a little bit of a note on. Not really looking to do anything personally with that. But first things first, here's what euro dollar looks like. This is for Michael. Hey, Mike, this is euro dollar, right? Here's what it looks like on the daily. Okay, so the euro dollar rally failed at a very interesting point. I know this is a little bit of a messy chart here, but just bear with me. So we were looking at this longer dated. This is the wider sort of ML formation from the highs that we made late last year. This was huge. And I know it looked like it kind of broke. It kind of turned right at that key October reversal outside day that came off the highs. We just failed ahead of it, and here we are to the move to the downside. The trade still remains constructive in my eyes above 110.45, 110.50. And what's there? You have the 200, day moving average. You have the 1618 extension from the advance off the low. You have the median line for the current operative formation also in play. And that all kind of gathers right there near 110.50. So on a simple three-wave correction, yes, you look for another low here to be made before you move higher again. As long as that low is preserved above 110.45, I still think you look to finally get back on the long side here. For the near-term chart for euro, here's what it looks like. And again, not very convincing for at least a near-term play from a scalp yet, which is why I didn't really want to put this in focus, but I am looking at this. So it kind of keeps the focus weighted to the downside here below the weekly opening range high near term. Again, ideally, you get to move back towards that 110.50 area to get back on the long. So we'd either be looking for a drop here for long triggers, or if it does rupture the highs here, still be cautious until we clear 112.60. Still a major pivot in price. It caught those highs 2 weeks ago. Even last week was a decent pivot break, instant resistance. That's going to be the validation of the move higher. Not only that, but it's going to be the objective weekly opening range high now, which comes in right around 112.50, 112.48. So looking for a decent, sort of rejection of key support here or a breakout to play back on the euro dollar, at least personally, Craig. That's what I'm looking for this pair. Does that help? Craig, any specific questions on the euro? Let me know. Or Michael, I'm sorry, that was for you. He says, yes, thank you. All right, cheers, man. And again, for me, I like actually the Euro Oz a little bit more, just for the juice that you're getting, Mike. I mean, 29 pips, yeah, it's a great scalp. That's typically what the scalp range is. But with the Euro Oz, the plays that it's been giving, you're getting 60 pip swings in each direction. A little bit more risky, but I think the ranges are there to be played. So that is euro dollar. I want to go into Craig's question here on CAD and oil. Again, just a quick look back. Here's what the oil chart looks like. We were talking about this earlier in the webinar, Craig. 31.45 is the major resistance that we're talking about. I tweeted this chart out yesterday. Nice confluence of the median line off the high, basic trendline support turned resistance, and the key 618 retracement of the decline from last month's high. Not surprising to get some kickback, but what I wanted to note is that you're seeing, what could be the makings of a change in behavior. Okay, not only because of the divergence that you're getting, obviously some strong bullish divergence with price action making a lower low, the oscillator making a higher low, but you've also got a change in behavior in that former basic trigger resistance now offering some support. So the validation for a more concerted reversal higher would need to be a break above that 31.45 level. Okay, so you might see another downside move from here on the up thrust. That's the region you need to clear to really validate a near-term reversal here in crude. So what does that mean for dollar CAD? Here's what it looks like on the daily first. Okay, a little bit messy, right? You'd expect to break out of this descending channel that held for 4 weeks to give us a little bit more of an upside thrust, which is why for the last couple of days, this chop fest, I'm not surprised if a lot of people tried getting cut up on this one. It's not really convincing to me on the daily chart, which is why I haven't really highlighted it as a major scalp for us yet. Here's what the near-term levels look like. I just wanted to highlight this basic trendline resistance. We were looking at this late into the week. Remember when this broke, invalidated the short side? Well, we're still sitting on that as support now, that same slope. So I'm still of the mindset, Craig, that you could get a decent rally here, a decent rally back towards 140, back towards 141 before we turn lower again. Now that would give crude a decent sort of relief as well in the near term. guys, am I back? Okay, sorry about that. The audio just cut out a second there on dollar CAD. What I wanted to say, guys, is essentially the entire dollar CAD February opening range, guys, is just 2 days. Okay, it's just the third and the fourth there. That 2 day stretch is the entire monthly opening range. So aside from my opinion or what anyone else says, objectively, that's the range break that you need to validate sort of your initial play here heading into the latter part of the month. All right. Any questions on the loonie? It's on our radar. I don't think it's an operable play, at least from my standpoint, just yet. But that's what we'll be looking for. See if we get another high here another test of the opening range high. Certainly be on the cards here before we break lower. So Craig, that's the crude chart, and again, when you put that in line with what you're seeing in dollar CAD, you could see a scenario where this makes another run at the lows. Maybe you see dollar CAD again, get a little bit of a move back towards the thrust, towards the opening range high before failing and moving off. And inevitably looking for sort of a turn here in crude. All right. Your thoughts on gold, says K. Yeah, sure. Here's what gold looks like on the daily chart. I always have to have thoughts on gold. I write the gold weekly forecast for Daily FX every week. So the stretch, listen, when you get these major stretches, okay, it's very important on these types of trades to stress more the close. So on a move like this that you saw on the 11th, where this thing just kind of just surged, right? A lot of people might have wanted to think this is a major key break, right? And in fact, to be quite frank with you, if we had closed with a good distance above that 1250 level, I mean, aside from this basic sliding sort of parallel here, there's really nothing on tap until 1285, and that's a 618 off the 2013 August high. Long story short, we closed pretty much more or less just right at that. The pullback here finding support right ahead of the 38.2 retracement. I still think you need to make one more low before getting back on the long side. Long story short, while above that upper median line parallel, we're liking the long side for gold. Okay, which is a great stark contrast to what the expectations were heading into 2016. And you know you got a lot of those people saying, oh, the Fed's going to move higher on rates. Gold doesn't pay a dividend. Once the Fed finally starts to move higher in rates, there's no inflation. Gold tends to find its major bid in the market when there are inflationary concerns. We've got the exact opposite, guys. There's deflationary concerns around the globe. And to stoke inflation, a lot of these countries are still running lower interest rates. You're seeing a risk-off environment where there's a lot of volatility in broader risk assets. These are all positives for gold, every single one of them. And just to put things, again, in perspective, trying to clear out some of the noise that you hear online and on TV, here's what gold looks like on the weekly chart, okay? This is no small move we've made, guys, okay? The major pivot last year that broke, I know we sailed through it a couple times, was really this 1155, 1151 level right here. Huge 1618 extension. This is from the record all-time highs. This is 618 retracement from the advance off the lows you made in 2008, so the entire crisis run, right? Big pivot in price. Like I said, he sailed through on the upside in the recoveries here a couple times, but that's the pivot that gave us essentially the confirmation that we should be looking higher. Now this rally stopped that basic trendline resistance again, like I said, from that late 2013 August high. Again, a pullback towards 1151, 1155 would be, not out of the realm of possibility, but still, while above this region, I'm still liking to move higher in gold. The immediate threat is for a move lower from here to open up the week. The broader trade, in my humble opinion, still you want to look for 1155, 1151 as key support here on gold. And remember that chart that we looked at earlier, guys, as far as the market's anticipation for future rate hikes from the Fed, you know, as that continues to deteriorate, it's only going to further help, or put a support or a bid under the gold trade. So I can't say I'm a raging gold bull yet, unless we clear this 1250 region to the upside, and I think that's sort of the last straw. But near term, look for a pullback to find some support ahead of 1155. Any questions on gold from here? Clean this up here a little bit. All right. So we covered euro, covered gold, covered oil, and CAD. All right, that's all the agenda, or I had on my list. I do just want to touch real quick on euro pound. This was a trade that we talked about last week, and I just wanted to look at one thing. You're putting out an outside reversal today here off the low, but more importantly, the initial opening range looks like it broke. So before we get bullish on the trade, I just wanted to highlight this slope that we were working with last week. If this slope is in play, then you'd look to see 78 as sort of the major resistance hold still. If it breaks through this, I'd be more than happy to buy pullbacks and continue to favor the long side for the broader trend that we've been following here in Euro Oz, or Euro Pound. Let me just snap these levels for you. There you go. So again, if you guys need to take a snapshot of any of the charts, always remember you have that camera in the top right-hand corner. Feel free. So again, sort of major key resistance, sort of major support right at the weekly opening range low. So a trade, I think you get a really nice play on this. If it breaks to the upside, don't go chasing. Wait for the pullback towards 78.19 again to get long, but that would be the validation for the continuation. A break below this, and I wouldn't necessarily want to get on the short side just yet. You have that last sliding parallel, and you have the key 618 at 76.60. This is the invalidation level for the broader sort of uptrend that we've been working with off that February low. All right, so not quite on the table yet. It's giving us a healthier ATR here. It's starting to get a little bit wider at 24 pips. Remember, they are pound pips though, so keep that in mind when getting involved in this trade. I did not, Gary. Let's take a quick look at dollar yen. Says you take a look at dollar yen. Here's what the Yenski looks like. It's very interesting because while we'll hate on this trade, we'll call it names and the abomination, the major key reversals that you see in dollar yen still, abide well with the technicals. Look at this level that we had highlighted way back in September, guys. 2618 off of the high from 2015, 111.02. The low that we made on that stretch last week was 110.96. Okay, just pips below, even below it before rebounding higher. So for me, at least what I was looking at yesterday, is I would stay bearish sub the median line. Sliding parallel off that high from that swing high in August, this is the region I'd stay bearish below. We came into it, didn't quite probe it, but I'd be looking for maintain a bearish bias below that region. Again, I'm not personally trading this, guys, but 30-minute. Just also snap these lines for you. There we go. So just another take on things. This is a long-dated median line formation just off the highs from November. You can see, although we've cleared the bottom side and cleared the top side, we continue to pivot off of these very nicely. Long story short, And the low day close comes in at 112.39.5. Huh. And it's just pips off the 618. Beautiful. Beautiful. That's your key region of support right here. Which low day close on the dollar yen? The low day close on dollar yen. The low day that we made, Eileen, that we made right here. What is that? The 11th? So the close of that session was 112.39.5 right here. And that's going to be the key support. And it also coincides dead on with that lower median line parallel on the daily chart. And it also coincides dead on with the key 618 retracement of the near term advance. So big level here for the for dollar yen. So I'm still going to hold a neutral bias here myself personally. This is going to be the bearish invalidation level for the broader decline, but not really still on the menu for me just yet. Sure can. Sterling dollar. Here's what sterling looks like. Sterling, I think, again, is another one of those pairs that is tempting a break. Remember this range we talked about last week? We were actually playing shorts off the sterling from this key resistance break. The short bias sort of for me ended when it got into 43.70. I stopped playing it after that. Last week was sort of just a mush around that region. We're breaking below it now, but Eileen, this is sort of the major key feature I'm looking at. So if we break below, well, let me put this in perspective. Here's sort of key support near term, okay? Which is why for me, I'm looking for some basing here in the sterling. If it breaks below, I think you have a much more stronger sterling short bias. And for me, with what we're looking at on the Aussie, that's why I put sterling Aussie on the menu. If you see specifically a downside break here in sterling dollar, the momentum signature certainly turning ahead of 50 does keep the downside bias in play. I thought this breakout was going to give us a more concerted run towards the upper median line parallel, but if we sink below this here today, forget about it. And I would expect that the 618 is probably a better thing to look at this point. And it's right there, 43 handle. Okay, so we'll look for some support right there. If we break sub 43, sayonara. I think the sterling's got a lot of downside to go. Keep in mind, in overnight trade, we did get some sterling data. We did get the CPI numbers, and here's what they look like. They weren't very strong, guys. And not only were they not strong, but you missed pretty much across the board. So we were looking for a contraction of 0.7. This is the month on month. Don't stress it. But the year-on-year core is really what the main stress is, or the headline figure, we'll call it. And that missed. So we were expecting a decline from 1.4 to slide to 1.3. We saw a bigger decline in consumer prices. So again, that deflationary concern slams. It just puts so much like weight on these central banks' shoulders, and it ties their hand with regards to policy. It certainly ties their hand with regards to normalization, and for the pound, certainly you're seeing that reflected here today on this decline. I wouldn't get too excited on the pound short again until we clear below 43. You have that nice confluence now. Okay, trendline support, 618, the median lines and the slider off the high, all right here. But this is certainly a little concerning. And if you remember, the BOE doesn't have the best track record with their inflationary targeting, and they have a singular mandate to really make sure that, or attain that 2% inflation target. We're not seeing that here now. We'll have to see if the data improves later this week. You do get the jobless claims count tomorrow, and that is expected to shine a little bit better. 3-month unemployment expected to drop to 5.0% from 5.1. All right. For the dollar crosses, by the way, guys, just a quick look at the economic docket for the U.S. The main hitter for the U.S. this week, watch industrial production numbers tomorrow, but more importantly, those CPI figures. And year on year, we are expected to see a nice increase. And this is something that the markets will be paying very close attention to. Again, specifically, the core year on year, stripping out food and energy, we're supposed to come in at 2.1%. If we do see both of these numbers come in with expectations, it would certainly wouldn't suggest that the Fed's going to hike rates, but these expectations that you might see the Fed continue, let me say this, the amount of hikes that we'll expect for 2014 I think will be upped if we start to see the inflation targeting at least moving closer towards goal. So look for that inflationary number or the inflation numbers on the 19th to be the major hitter for all the dollars crosses this week. Mark says, always love your excitement when fibs line up, right? It's awesome. Those confluences tend to be my favorite and best plays. Eileen's noting the weakness in the CPI data. And we got dollar yen for Gary. All right, guys, that's 9:32. Markets are coming online now. I got to run. I will be back tomorrow morning, 8:30 Eastern, same time, same place, for another look. Keep your mind open. It's just the opening range is actually starting to come online with the U.S. markets for the first time this week. So we'll be watching these ranges, but broadly speaking, look for a resolution on some of those crosses that we've been covering, specifically on the weekly opening ranges. Guys, I'll see you tomorrow morning. Best of luck trading. Cheers.